Welcome to the Deep Dive, where we cut through the noise to give you the insights you really need. And this is our TalkTickers segment, where we break down key earnings calls. Today, we're diving into EMCOR Group, that's ticker EME. We're looking at their Q2 2025 earnings call from July 31st. We'll hit the main financials, dig into what management talked about strategically, and try to put it all in context for you. And this one's interesting because, look, the numbers were great, but the market reaction, a bit complicated. Let's unpack it. Okay, so first up, the results snapshot. EMCOR really delivered a strong quarter, didn't they?
Oh, absolutely. I mean, diluted earnings per share, $6.72. That's a solid 17% beat over the consensus, which was around $5.74.
Yeah, significant beat. And revenue.
Revenue also impressive. A record $4.3 billion. That beat the $4.11 billion consensus by about, 4.6%? And it's up over 17% year over year.
17.4%. Yeah, just really strong top-line growth there.
And it wasn't just growth, it was profitable growth. They hit a record operating margin, 9.6%.
Wow, 9.6%. That pushed operating income up quite a bit then.
It did. $415 million in operating income, which is up 25% compared to last year.
Okay, record revenue, record margin. What about the future pipeline? The backlog?
That's maybe the most impressive number. The remaining performance obligations, or RPO, that's their backlog, hit a new record too, $11.9 billion.
$11.9 billion. How does that compare?
It's a huge jump. It's up 32% year over year, really substantial.
Okay, so let's just recap. Record revenue, record margins, massive record backlog, significant beats top and bottom line. You'd think Wall Street would just love that, right? Stock goes straight up.
You would absolutely think so. And, well, initially in pre-market trading, it did jump up over 3%.
Right.
But then something happened during or after the call. The stock reversed course completely. It actually closed the day down over 3%.
Down 3% after those numbers.
Exactly. It tells you investors were listening very closely to the call itself, maybe the guidance, maybe the tone, and something just didn't sit right despite the headline numbers.
And the trading volume reflected that.
Oh, yeah. Spiked to about 1.3 times the normal 90-day average. A lot of shares changing hands, a lot of reaction. So there's a disconnect somewhere.
That's the puzzle then. Strong numbers, negative reaction. So let's dig in. How did the CEO frame these results? What was their take?
Well, the CEO really hammered home the point that demand is strong, that these specialty contracting services EMCOR provides are, really in demand. That's what led to all these records. They emphasized that the strength was broad-based, particularly in the core electrical and mechanical construction segments.
Okay, broad-based strength. Did they mention how they're achieving this, especially the margins, in a potentially tight labor market?
They did. They pointed specifically to operational excellence. They mentioned using things like virtual design construction, VDC, building information modeling, or BIM, and also prefabrication.
Right, VDC, BIM, prefab. We hear these terms a lot. Are they actually making a difference on the ground for EMC? Or just, buzzwords?
That's a fair question. For EMCOR, it seems like they're really integrating these as key tools. They're means and methods, as they call them. Think about VDC and BIM. They let you model the entire project digitally first. You find clashes like a pipe hitting a duct before you build.
So less rework on site.
Exactly. Less rework, fewer delays, saves money, and it's safer too. And prefabrication, building complex parts in a factory, then assembling on site.
Faster installation, less weather dependency.
Precisely. And it helps manage labor more efficiently. So yeah, they're not just buzzwords. They seem to be real drivers of productivity and ultimately those strong margins.
Okay, that makes sense. So these methods are helping drive efficiency. Now let's look at the revenue growth. That 17.4% consolidated jump. Where did that mostly come from? Which segments were the powerhouses?
It was definitely led by construction. U.S. electrical construction specifically was just on fire. Revenue there was up 67.5%.
67.5%. Wow. What fueled that?
It was a mix. Strong organic growth, definite.
Yeah.
But also the Miller Electric acquisition they completed back in Q1 played a huge role. They highlighted strength in data centers, healthcare, and commercial fit-outs within that segment.
Okay. And the other big construction segment, mechanical.
U.S. mechanical construction grew too, about 6%. And they said that was almost all organic growth, which is, quite healthy. That was driven by data centers again, plus food processing and hospitality projects.
So the Miller Electric acquisition, that was a significant contributor overall then.
Oh, absolutely. They said it added over $330 million in incremental revenue just in Q2.
Yeah.
It's clearly opening doors, especially in healthcare, and giving them more chances to cross-sell services.
So mostly strong performance, but were there any weaker spots?
There were, U.S. building services seems to be turning a corner, which is good news.
Yeah.
Mechanical services growth is now outpacing the declines they saw before in the site-based part of that business. But industrial services definitely face challenges. Revenue there was down over 13%.
13%. Why the drop?
Management pointed to lower field service volumes and fewer sales of new heat exchangers. They do expect that to improve later in the year, but it was a drag in Q2.
Okay. Any word on international?
Yeah, UK building services actually had a strong quarter. Revenue's up over 26% there.
Yeah.
So a bit of a mixed bag outside of the core construction strength, but mostly positive.
Got it. Back to that RPO number, $11.9 billion. You said it was up 32% overall, but how much of that was organic versus acquisitions like Miller?
That's a key point. The organic RPO growth was still very strong, up 22% year over year.
22% organic. Okay, so they're definitely winning new business, not just buying it.
Exactly. It shows real underlying demand and market share gains.
Yeah.
It gives them great visibility into the next, 12, 18, even 24 months.
Can we break that RPO down? Where are the big pockets of work?
We can. Network and communications, it's basically data centers, hit a record $3.8 billion in backlog. Just huge demand there.
Unsurprising given the AI boom.
Right. Healthcare RPO is now $1.4 billion, clearly boosted by Miller Electric. Manufacturing and industrial RPO also hit $1 billion.
$1 billion there. What's driving that?
Management linked it directly to onshoring and reshoring trends. Think semiconductor plants, other critical manufacturing coming back, plus new projects in food processing and renewables.
Interesting. Any other notable areas?
Yeah, water and wastewater RPO stood at $725 million, driven by ongoing Florida projects. And they specifically mentioned landing a Phase 2 mechanical contract for a semiconductor client. That boosted their high-tech manufacturing backlog sequentially.
So the backlog really reflects these big secular trends, data centers, onshoring, infrastructure.
Absolutely. It's not just growth. It's growth aligned with major shifts in the economy.
Okay, let's pivot to margins again. That record, 9.6% consolidated margin. Both electrical and mechanical construction expanded margins by 70 basis points. How sustainable is that? What did management say?
They attributed it to, and I quote, excellent project execution, enhanced productivity, and a more favorable mix. Basically, doing good work on the right projects.
But can they keep it up? That's always the question with construction margins.
Right. Management's view is, look, don't focus on one quarter. They look at trailing 12-month or even 24-month averages. For the construction segments, that average is running somewhere between, say, 12.25% and 13.25%.
Okay.
So their view is that these current levels, while maybe at the high end, are broadly sustainable because the underlying operational improvements like using VDC and BIM are structural.
And that confidence presumably flowed into their guidance despite the market's weird reaction.
It absolutely did. They raised their full-year guidance pretty significantly.
Okay, what are the new numbers?
Revenue guidance was narrowed upward. Now they expect $16.4 billion to $16.9 billion for the full year.
Tightening the range higher. Good sign. What about earnings?
Non-GAAP EPS guidance got a big boost, raised to $24 to $25.75. That's up to the previous range of $22.65 to $24.
That's a substantial raise. And operating margin guidance.
Also up. They're now guiding to 9.0% to 9.4% for the full year. Management explicitly said the raise reflects the strong Q2 and their positive outlook for the second half. They're not backing down.
Interesting. And quickly, any word on capital allocation, buybacks, M&A?
Yeah, they've been active. In the first half of 2025, they spent over $430 million on share repurchases.
Okay.
Of course, the big acquisition spend was earlier, but total M&A in the first half was around $887 million, dominated by Miller. Shows they're using that strong balance sheet. They still have plenty of liquidity and credit available.
Okay, let's zoom out a bit. Put this in the investor context. EMCOR seems perfectly positioned for some big trends, right? Data centers, CHPS Act, driving semiconductor plant construction, sustainability retrofits.
Definitely. They're surfing some powerful secular waves.
Yeah.
And it shows in their stock performance over time. Even with this recent dip, EMCR has consistently beaten the broader XLI industrial ETF over the last month, 3 months, year.
So sustained outperformance. And the recent run-up was fueled by Miller, the margin beats, and that whole AI data center excitement.
Pretty much, yeah. Those are the key drivers pushing the stock higher leading into this earnings report.
But now we have this divergence. Management is bullish, raises guidance. Sell-side analysts seem to agree. You mentioned UBS, D.A. Davidson, calling them a premier AI play, raising targets. But the market reaction was negative, and you said some funds were trimming positions.
Exactly. It's a fascinating split. The sell side sees the long-term story, the strategic positioning, the execution. But some on the buy side, maybe looking at the valuation after the run-up, got a little cautious post-call. Perhaps the guidance raise wasn't quite as high as whisper numbers, or maybe there was just some profit taking. It highlights that mixed sentiment.
So what are the potential catalysts investors might be watching for now?
Near term, it's about execution. Seeing that Phase 2 semiconductor project ramp up smoothly in the second half. Winning more of those Florida water projects or hospitality jobs.
Yeah.
Basically, delivering on the promise of that huge backlog.
And longer term.
Well, there's potential for an investor day, maybe late Q4. That would be a chance for management to detail synergies from Miller Electric, maybe update on capital return plans like buybacks. That could certainly move the needle.
And the bull case is what continued growth leads to significantly higher EPS down the road.
Yeah, if they can keep up this kind of high teens organic growth, execute well, maybe hit $30 in EPS by 2027, that's a plausible path people are modeling.
Of course, there are always risks, right?
Always. A major economic slowdown hitting capital spending would obviously hurt. Construction always has project risk cost overruns, delays. That could definitely pressure those strong margins they've been posting, though again, their methods like VDC aim to minimize that.
Okay, makes sense. Now let's shift gears to our segment. This is not financial advice. Just some ideas sparked by the call, purely informational, maybe a little provocative.
All right, fire away. What outrageous but plausible ideas did this call inspire?
Okay, idea 1. The post-whipsaw alpha play.
Intriguing name.
Right. The idea is simple. The fundamentals look great. Record backlog, raised guidance, secular tailwinds. That post-earnings dip, maybe it's just short-term market jitters and overreaction.
So the trade is?
The trade is basically betting against that immediate negative reaction, maybe initiating a long position in EME on this weakness, believing the strong fundamentals and management execution will win out over, say, the next 12, 18 months.
The outrageous part is fighting the tape immediately after a sharp reversal, but plausible because the underlying business performance is strong. I get it.
Exactly. Okay, idea 2. The secular growth versus cyclical lag pair trade.
A pair trade. Getting fancy.
A little bit. So we know EMCR strengths are data centers, onshoring these secular growth areas. But we also heard the industrial services segment is lagging, and that's more tied to the economic cycle.
Right. Down 13% revenue in Q2.
So the trade idea is go long EME to capture that secular upside in operational strength, but hedge it by shorting something more exposed to the cyclical downside. Maybe a less diversified industrial services competitor, or even a broad industrial ETF that's heavy on cyclical names.
Okay, so you're isolating EMCR's specific strengths while hedging the broader industrial cycle risk that affects his weaker segment.
Precisely. The outrageous part is the complexity executing a pair trade based on nuanced segment performance from one earnings call. But plausible because management gave us that detailed breakdown.
Interesting ideas. Definitely not advice, but certainly food for thought.
Absolutely. So let's wrap up our deep dive on EMCR's Q2. Key takeaway. Despite that confusing market reaction, the company delivered a very strong quarter. Records across the board, revenue, margins, backlog.
Yeah, driven by smart positioning in booming markets like data centers and onshoring, plus solid execution. And management doubled down with raised guidance, showing confidence.
It really seems like a case where the immediate market narrative maybe didn't capture the full picture of the underlying business strength.
Could be. And maybe a final thought for listeners to chew on. Think about those operational tools. VDC, BIM, prefabrication.
Right, the means and methods.
Yeah. We talked about how they drive efficiency now. But how much more value can they unlock? Could these tools fundamentally change the profitability profile for specialty contractors like EMCR in the long run? Maybe pushing margins even higher than current expectations.
Are these tools creating a lasting competitive advantage that the market hasn't fully priced in yet? That's definitely something to consider.
Exactly.
Well, that's all the time we have for this TalkTickers segment on the Deep Dive. Thank you for joining us. And remember, everything we discussed today is for informational purposes only. It is definitely not financial advice. Please do your own research before making any investment decisions. Until next time, keep digging deeper.